Warren Buffett's investment philosophy, formed during his formative years, is a fascinating topic. The everyday events he experienced during this time became valuable lessons, eventually leading him to earn billions. Buffett's epiphany was realizing that his teenage business ventures and stock investments were fundamentally the same. Like many of us, he was interested in various businesses and stock investments, but struggled to see the connection between them. At 16, in 1946, Buffett bought a pinball machine for $25 and placed it in a barbershop. Customers paid 5 cents to play, and the profits were shared between the barbershop and Buffett. On the first day, he earned $4, and by the end of the week, $25, enough to buy another machine. Within a year, he was making $50 a week, and he eventually sold the business for $1,200. Adjusting for inflation, which is about 14 times higher now, Buffett's initial investment would be akin to $350. He would be earning $700 weekly, $3,000 monthly, and $36,000 annually, impressive for a teenager. Selling the business for $16,800, he turned $350 into $52,800 in a year, a 150-fold increase, yielding an astonishing 15,000% return. Buffett later shared this story with Bill Gates, joking that he had peaked very early in his business career. However, during this period, Buffett's approach to stocks was more casual, viewing them as a form of thematic investing without deeply understanding their connection to businesses. His perspective shifted after reading Benjamin Graham, realizing stocks represent shares in businesses. He was struck by how many overlook this simple truth, creating enormous investment opportunities. For example, if we could buy his pinball business after a month, considering it was already making about $3,000 monthly, how much should it cost? The business could potentially bring in $36,000 annually for many years, offering a significant passive income. The business's price could be based on the value of the physical machines, about $700. However, no one would likely sell at that price. Using bond logic, a 10% yield on $36,000 annual income would value the business at $360,000 in the market. Considering competition showing up, let's say the purchase price was $100,000. This implies a price of 2.7 times annual income, or a 37% return rate, an attractive proposition. This specific study case is amazing because it leads us to understand the value of intangible assets like goodwill or customer loyalty. The regulars were generating $3,000 monthly for the barbershop. Without these regulars, the business would be worth just $700, the value of the machines. Their loyalty created an additional value of $99,300. Recognizing and valuing such intangible assets is crucial for investors. Buffett's ability to understand and articulate the importance of these business principles, including concepts like economic moats and intrinsic value, reshaped investment thinking. Surprisingly, these concepts are still not universally applied in the investment world. This overview of Buffett's early business ventures and investment philosophy shows how simple business principles can lead to profound investment insights, shaping an immensely successful investment career.